Thanks for clicking. Big changes are coming to Canada's mortgage market. This is the conclusion that could be drawn from the headlines following Finance Minister Chrystia Freeland's fiscal update.
Everything is different.
Indeed, from announcing that Canada would be loosening the stress test for mortgage renewals under the release of the new mortgage charter, it would appear as though big changes are coming to Canada's mortgage market. Yet, a closer look at the proposed changes shows that we're not seeing any real changes at all, and not just because the mortgage charter is voluntary. So what I want to do today is go over the newly proposed mortgage charter, take a look at the extent to which the rules in the mortgage market are actually changing, and then offer a few brief comments on the state of the media.
Smarten up.
The end of the month is fast approaching, and with that we are eagerly awaiting the release of November's real estate data, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this mortgage charter. Onto the mortgage charter. So what are these big changes coming to Canada's mortgage market? The charter lays out 6 expectations that the federal government has for how financial institutions are to work with Canadians.
Be nice.
The first item in the charter is for lenders to allow the extension of the amortization period for borrowers at risk. So, allowing borrowers to extend the life of their mortgages, which, all things being equal, should lower their payments. Given that there have been so many concerns about the impending renewal crisis coming up in 2025 and 2026, at first glance this looks like it would definitely help. Yet, as we've talked about so many times on this channel, this is already happening for holders of variable rate mortgages with fixed payments, who have seen their amortizations extended up to 60, 70, even 90 years in some cases. As such, while it doesn't specify, the charter must be talking about those coming up for mortgage renewal. However, as we've already talked about at great length on this channel, amortization extensions are already available at renewal. Banks already offer this, with the only 3 caveats being that not all lenders do it, you have to requalify to get them, and the rules differ for insurable and insured loans, which can affect the interest rate. The charter, as it stands now, doesn't outline how these caveats will be changing, only directs the banks to offer extended amortizations, which they already do. And this brings us to the second major change being proposed by the charter, the change that so many are discussing online, that insured mortgages no longer have to requalify when borrowers are switching lenders. The idea is that with interest rates so much higher than they were 5 years ago, when borrowers go to renew now, when borrowers go to renew in a year from now, they'll be facing much higher interest rates. And if they have to requalify in order to switch lenders, they might not be able to. As such, they'll be stuck with their current lender and have to take whatever rate is offered by their current bank.
You'll give me what I tell you to give me.
Pretty much. But under this proposed change, homeowners wouldn't have to requalify if they go to switch lenders, which the government hopes would ensure more competition, hence lower interest rates among lenders. If your current lender knows that you can go elsewhere, they're much more likely to offer you a better rate at the time of renewal. And this all sounds great, except that about a month ago, OSFI, Canada's banking regulator, issued a report clarifying that there already was an exemption for borrowers looking to switch lenders at the time of renewal. We already had this. CMHC confirmed at the time that that exemption already existed, so long as no additional funds were being added and the amortization remained the same. So, we already had this. Borrowers could already switch without having to requalify. The only problem was that lenders were reluctant to do it. It was still at the lender's discretion whether or not borrowers had to requalify for a switch. And, as mentioned, the mortgage charter is voluntary, so it's still at the lender's discretion whether or not they want to requalify on a switch. The lenders had the choice pre-charter, and the lenders continue to have the choice post-charter. So, while we're seeing headlines about major changes coming to the mortgage stress test, the policy really isn't new. This was a policy that was clarified by OSFI in October. The government announced its support for its own policy, and the news outlets and TikTokers ran with it. Third, the mortgage charter directs the banks to give distressed homeowners the option of making lump sum payments to avoid negative amortization or be able to sell their principal residence without major penalty. This is sort of a half measure, and even then, not really. The majority of banks, lenders, credit unions, etc. already allow lump sum payments. They already offer prepayment privileges, usually 10, 15, 20% per year, where borrowers can make 10, 15, 20% lump sum down payments each and every year. Further, for those mortgages that we've talked about so many times on this channel, those negatively amortizing mortgages, the banks are already asking for, sometimes even requiring, lump sum payments. The government didn't need to direct them to do so. With that said, asking the banks to waive any penalties if a distressed homeowner has to sell, that is something new. Unlikely, but new. As we've seen before, penalties for breaking your fixed rate mortgage can run in the tens of thousands of dollars. depending on the bank and depending on the type of rate.
Excuse me, but I think a modicum of gratitude would not be out of line here.
So, the idea coming down from the government is that distressed homeowners might be less inclined to sell if they knew they were going to have to pay out tens of thousands of dollars in penalties. And, were those penalties to be waived, we could see a lot less forced sales. But that is a big if. As mentioned, this charter is voluntary. Are banks going to voluntarily give up $30,000 in penalties? Finally, the three other measures contained in the charter, those not really making the headlines, discuss waiving fees and contacting clients in a timely manner. Not really any major changes there either. So, we have this widely publicized mortgage charter coming to Canada, which allows extended amortizations, which we already have, enables switching mortgage lenders without having to requalify, which was already allowed and very few do, and directs the banks to allow for lump sum payments to avoid negative amortization, which the banks already do, sometimes even requiring it. And all of that isn't even to mention that this is all voluntary.
I'm trying to help you out.
Indeed, in very few, if any, of these articles was it mentioned that we already have a lot of these measures. In fact, the CBC article on the mortgage charter didn't even mention that any of these measures were in fact voluntary. A lot of borrowers are currently in, or are going to be in, a lot of financial trouble. And we have the government and the news networks saying that relief is coming, when nothing of actual substance is in fact on the way. These changes don't have the force of law, and they're not really changes anyway. Most of the things in this charter were already available. Either the government, the news networks, the online commentators didn't bother to mention that we already have most of these measures in place, which is a problem, or they didn't know, which is a problem in and of itself. With that said, whether or not the banks are going to tweak any of their existing policies stemming from this mortgage charter remains to be seen, but we'll obviously continue to track it on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.